What if I told you that Marcus, a 24-year-old with $500 in savings, now generates $3,700 monthly through a combination of AI-powered crypto trading and tokenized real estate investments? Or that Jennifer, a 42-year-old office manager, replaced her entire salary with passive income from 3 specific DeFi platforms? In this video, I'm revealing the exact systems that 5 regular people are using to build wealth with AI and crypto in 2025. You'll see the complete breakdown of their strategies, including which tools worked, which ones failed, and how much money they started with. These aren't crypto millionaires or tech geniuses. They're regular people who found practical entry points into the new economy. Meet Marcus. From $500 savings to $3,700 monthly income. Let me introduce you to Marcus Chun, a 24-year-old barista with a story that might just change how you think about building wealth in today's economy. Just 18 months ago, Marcus was working double shifts at a coffee shop in Seattle, drowning in $42,000 of student debt, and living paycheck to paycheck with barely $500 in his savings account. I was making great lattes but terrible financial decisions, Marcus jokes now. Every month was the same cycle: pay rent, make minimum payments on my loans, and watch whatever was left disappear on basic necessities. Sound familiar? Marcus represents millions of young adults caught in the same financial trap. But what happened next might surprise you. While scrolling through social media during his break one day in early 2024, Marcus stumbled across a video explaining how regular people were generating passive income using AI-powered crypto tools. Intrigued but skeptical, he decided to take a chance with $200 of his precious savings. I went in completely blind, Marcus admits. I heard about this new token that was supposedly the next Bitcoin and threw my money at it without understanding the first thing about blockchain technology or market fundamentals. You can probably guess what happened. Within 2 weeks, his $200 investment had shrunk to just $34. This is where most people would quit, write off crypto as a scam, and go back to the daily grind. But Marcus did something different. That loss was actually the best thing that could have happened to me, he explains. It forced me to slow down and realize I needed to educate myself before investing another penny. Marcus spent the next 3 weeks watching tutorials, reading beginner guides, and joining Discord communities focused on responsible crypto investing. That's when he discovered Magnify, an AI-powered investment assistant designed to analyze market patterns and identify lower-risk opportunities. Rather than chasing get-rich-quick tokens, Marcus took his remaining $300 and followed a completely different strategy. He focused exclusively on stablecoins, cryptocurrencies designed to maintain a steady value by being pegged to traditional currencies like the US dollar. I started super conservative with USDC on Coinbase, which was offering about 4% annual yield at the time, Marcus explains. It wasn't exciting, but I knew my money was on a regulated platform and wasn't going to disappear overnight. As his confidence grew, Marcus began diversifying his approach. He set aside 30 minutes every morning before his barista shift to review AI-generated market insights. The AI tools were analyzing thousands of data points that would have taken him weeks to process manually. The game changer was when I discovered I could stake my stablecoins in DeFi protocols that were offering 8 to 12% annual yields, says Marcus. And I could use AI tools to compare risk levels across different platforms, which made me feel much more confident in my decisions. By month 3, Marcus had turned his initial $300 into about $400. Not life-changing, but a solid 33% return that convinced him he was on the right track. He began adding $50 to $100 from each paycheck, slowly building his position. What I love about using AI for this is that it takes emotion out of the equation, Marcus explains. When everyone was panicking during a market dip, my AI assistant was highlighting opportunities based on historical patterns, not fear or hype. The real breakthrough came 6 months into his journey when Marcus discovered tokenized real estate platforms. These innovative platforms use blockchain technology to fractionalize property ownership, allowing investors to purchase small stakes in income-generating real estate with as little as $50. This completely blew my mind, Marcus says. I always thought real estate investing was for wealthy people with hundreds of thousands in capital. Suddenly, I could own a tiny slice of apartment buildings in growing cities and receive proportional rental income. all managed through smart contracts. Using his AI tools to analyze property fundamentals, location growth metrics, and platform security, Marcus began allocating 60% of his crypto portfolio to tokenized real estate investments spread across multiple properties and platforms. The AI would flag properties in areas with strong rental demand, low vacancy rates, and positive economic indicators, he explains. I could filter for income-generating properties that paid out monthly distributions rather than appreciation-focused investments. 9 months into his journey, Marcus was generating enough passive income to cover his student loan payments. By the 1-year mark, his side hustle was bringing in more than his barista job. Today, Marcus has built his initial $500 investment into a sophisticated portfolio that generates $3,700 in monthly income, all while working just 5 to 7 hours weekly, maintaining and adjusting his strategy based on AI insights. His portfolio now includes 60% in tokenized real estate across residential and commercial properties, 25% in stablecoin lending protocols with 8 to 12% annual yields, 10% in blue-chip cryptocurrencies like Bitcoin and Ethereum, 5% in carefully selected DeFi governance tokens that pay dividends. I still make coffee, but now it's just for myself in the morning, Marcus laughs. I quit my barista job 3 months ago to focus on growing my system and helping others do the same. What's most surprising is that Marcus isn't a tech prodigy or finance major. He studied art history in college and admits he still doesn't understand all the technical details of how blockchain works. You don't need to be a programmer or financial analyst to make this work, he insists. The AI tools handle the complex analysis. Your job is to set boundaries, understand the basic principles, and make thoughtful decisions based on the insights the technology provides. Marcus credits his success to 3 key principles that anyone can apply. First, he started with education before investment. Understanding the difference between speculative tokens and actually useful blockchain applications was critical, he says. The AI tools can analyze data, but you need to know what questions to ask. Second, he focused on income-generating assets rather than appreciation. I wanted cash flow, not the stress of trying to time market peaks and valleys, he explains. Every investment I make has to generate regular income. That's my non-negotiable rule. Third, he built redundancy into his system. I never keep more than 15% of my assets on any single platform or property, Marcus says. If one platform has issues, it's an inconvenience, not a catastrophe. The journey wasn't without challenges. Marcus faced skepticism from friends and family, navigated the complexities of crypto taxation, and weathered market volatility. But the systematic approach and protection offered by AI-guided decision-making helped him stay the course. The biggest mistake people make is chasing whatever token is trending on social media, Marcus warns. That's gambling, not investing. True wealth building is methodical and often boring. It's about consistent small wins that compound over time. For those inspired by Marcus's journey, he recommends starting with no more than 5% of your savings and focusing first on regulated exchanges offering stablecoin yields. From there, you can gradually explore DeFi protocols and tokenized real assets as your knowledge and confidence grow. Jennifer's DeFi strategy: how an office manager replaced her salary. Speaking of regulated exchanges, that's exactly where Jennifer's journey to financial independence began. But unlike Marcus, who diversified across various crypto assets, Jennifer took a remarkably different approach. At 42, this office manager discovered how to replace her entire $58,000 salary without touching a single volatile cryptocurrency. Her method might challenge everything you think you know about generating passive income in the blockchain space. Jennifer Rodriguez had been working as an office manager at a dental practice for nearly 15 years. The job paid her bills, but she felt increasingly trapped in a career with limited growth potential. What kept her up at night, though, wasn't her job, it was her retirement savings. At 42, she had managed to set aside $32,000, but the math wasn't adding up for her future. I was watching my retirement account grow at a snail's pace while inflation was eating away at my purchasing power, Jennifer explains. The traditional financial advice wasn't working. My bank was offering less than 1% interest, and even high-yield savings accounts were barely keeping up with inflation. The turning point came during a weekend financial workshop where a speaker mentioned regulated stablecoin platforms offering returns that made Jennifer do a double take. 7 to 9% annual yields. Initially skeptical, she started researching DeFi, decentralized finance, but with a crucial difference from many crypto enthusiasts. I had no interest in the volatility of Bitcoin or other cryptocurrencies, Jennifer says. I wasn't looking to gamble, I needed reliable, steady returns that wouldn't disappear overnight. Her research led her to dollar-backed stablecoins, cryptocurrencies designed to maintain a value equal to $1. Unlike Bitcoin or Ethereum, these coins aim for price stability rather than appreciation, making them ideal for risk-averse investors like Jennifer. After weeks of careful research, Jennifer took her first step, investing $5,000 of her savings across 3 carefully selected platforms. She chose Aave and Compound Finance, 2 established DeFi protocols with strong security track records, and supplemented these with Coinbase's regulated USDC lending program, which typically offers between 4% to 6% interest on USDC holdings while providing compliance with U.S. financial regulations. I spread my investment across multiple platforms for safety, Jennifer explains. If one platform had issues, I wouldn't lose everything. That was non-negotiable for me. What really set Jennifer apart was her methodical approach. She created a detailed spreadsheet tracking every investment, platform risk assessment, and yield comparison. This wasn't just a hobby. It was a financial strategy with the explicit goal of eventually replacing her salary. As her confidence grew, she gradually increased her positions. Each month, she would reinvest her earnings and add a portion of her salary to her stablecoin holdings. This compounding strategy accelerated her passive income growth in ways traditional savings accounts simply couldn't match. The first few months, I was earning about $35 in passive income. It wasn't life-changing, but seeing actual returns made something click, Jennifer recalls. By month 6, I was earning over $200 monthly without doing anything additional. That's when I realized this could actually work long-term. Jennifer's cautious nature actually became her strength. While many crypto investors chase high-risk, high-reward opportunities, she maintained her focus exclusively on stablecoins. This approach required more capital to generate significant returns, but it also protected her from the wild price swings that define cryptocurrency markets. Her dedication to the strategy never wavered. For 3 years, she consistently added to her positions while reinvesting every dollar earned. She worked overtime at her job and cut expenses where possible to accelerate her investment timeline. The math was straightforward but powerful. To generate an annual income of $58,000 at her average 9% yield across platforms, Jennifer needed approximately $644,444 invested in stablecoins. If rates dropped to 7%, she'd need closer to $828,571. Understanding this target gave her a clear goal to work toward. I didn't get there overnight, Jennifer emphasizes. Building this kind of passive income took consistent effort and patience. But I knew exactly what I was working toward, which made staying motivated much easier. By her 3rd year, Jennifer's stablecoin investments had grown substantially, but she wasn't quite at her goal. That's when she made a key discovery that accelerated her timeline. She found she could use her stablecoin holdings as collateral on certain platforms to borrow additional stablecoins at 3 to 4% interest rates, which she then deployed to earn 9% elsewhere, capturing the spread as additional income. This leverage strategy, when used conservatively, allowed her to boost her effective yield while maintaining a safety buffer. Jennifer was careful to keep her loan-to-value ratio below 40%, giving her ample protection against market fluctuations or platform issues. The most important thing I learned is that you don't need to take big risks to benefit from blockchain technology, Jennifer stresses. Everyone talks about crypto millionaires who got lucky with Bitcoin or some random token, but there's a much more sustainable approach that gets far less attention. Today, Jennifer has achieved what once seemed impossible. Her stablecoin portfolio generates enough passive income to replace her entire $58,000 salary. She continues working reduced hours at the dental practice by choice, but financial necessity no longer drives her decision to work. What makes her approach particularly notable is its accessibility. While Jennifer eventually invested a substantial amount to fully replace her income, her strategy works at any scale. Someone starting with just $1,000 can implement the same approach and begin generating passive income immediately. The biggest myth in crypto is that you need to take massive risks or time the market perfectly, Jennifer says. My returns aren't headline-grabbing, but they're consistent, and I sleep well at night knowing my money isn't riding the crypto roller coaster. Jennifer's approach offers several lessons for anyone interested in generating passive income through DeFi. First, consistency trumps timing. Jennifer never tried to predict market movements or jump between different investment options. Her steady, methodical approach removed much of the stress that often accompanies crypto investing. Second, risk management matters more than maximum yield. By spreading her investments across multiple platforms and focusing exclusively on dollar-backed stablecoins, Jennifer created a system that could withstand turbulence in any single platform. Third, compound interest becomes truly powerful with patience. Jennifer's initial returns seemed small, but reinvesting consistently allowed her money to grow exponentially over time. Perhaps most importantly, Jennifer's story demonstrates that blockchain technology offers benefits beyond cryptocurrency speculation. She never bought a single Bitcoin or Ethereum, yet she leveraged the efficiency of blockchain platforms to generate returns that traditional financial institutions simply couldn't match. For those interested in following Jennifer's approach, she recommends starting with no more than 5 to 10% of your savings, focusing exclusively on regulated platforms with established security track records. From there, you can gradually increase your positions as you become more comfortable with how these systems work. Michael's AI side hustle: how a teacher makes an extra $2,000 monthly. Unlike Jennifer, who built her wealth through patient investing, Michael found a money-making opportunity hiding in plain sight. Did you know businesses are willing to pay premium rates for something AI tools can't fully deliver on their own? This overlooked gap in the market is how a regular teacher with no special tech skills earns an extra $24,000 yearly. And the best part, he never invested a single dollar in cryptocurrency. Meet Michael, a high school English teacher from Portland who was feeling the financial squeeze. At 38, his $52,000 salary wasn't quite cutting it with rising living costs and a growing family. He needed extra income but faced the classic teacher's dilemma: plenty of education and skills, but limited free time to use them. I was grading papers until 9 p.m. most nights, Michael explains. The idea of driving for Uber or working retail on weekends sounded miserable. I needed something flexible that could work around my teaching schedule. Like many of us, Michael first tried his hand at traditional freelance writing. He created profiles on popular platforms and started bidding on content creation jobs. But he quickly discovered a harsh reality. The general freelance marketplace was brutally competitive. I'd spend hours crafting proposals only to get outbid by someone willing to work for pennies, he recalls. When I did land jobs, they paid so little that I was essentially earning minimum wage for professional work. It just wasn't sustainable. The turning point came when Michael stumbled across a fascinating trend. While browsing job boards, he noticed companies were specifically requesting human-enhanced AI content and offering significantly higher rates than standard writing gigs. Some listings mentioned payments between 10 cents to 50 cents per word, rates that made Michael do a double take compared to the 3 cents per word he'd been fighting for. This discovery led him down a research rabbit hole. He found that as AI tools became mainstream, businesses were facing a new problem. They loved the efficiency of AI-generated content, but were frustrated by its limitations. The lack of genuine expertise, personality, and the human touch that readers could sense was missing. These companies had a pain point I could solve, Michael explains. They weren't looking for someone to write from scratch. They needed someone who could take AI-generated drafts and transform them into something that actually connected with readers. Michael started experimenting with AI tools like ChatGPT, Claude, and Jasper. He discovered he could generate rough content drafts in minutes rather than hours. But the real value came from what he did next, applying his years of teaching experience to enhance these AI outputs. The AI might get the facts right, but it couldn't replicate my experience explaining complex topics to confused teenagers, Michael laughs. I knew how to take something robotic and make it relatable. Rather than competing on general freelance sites, Michael made a strategic pivot. He created specialized service packages specifically for financial education platforms and educational technology companies. niches where his background gave him credibility. His pitch was simple but effective. I'll turn your AI drafts into content that actually sounds human, with the expertise of someone who's spent 15 years making complicated subjects understandable. The response was immediate. Companies that had been struggling with the uncanny valley of AI content were willing to pay premium rates for Michael's human touch. Financial writing proved especially lucrative, with some clients paying over $1 per word for content that required both accuracy and engagement. These businesses were already using AI tools internally, Michael explains. They didn't need me to write articles from scratch. They needed someone who could quickly review AI-generated drafts, inject personality, correct subtle inaccuracies, and make the content shine. To maximize efficiency, Michael developed a systematic approach. He created templated prompts for different content types and built a library of customization techniques. This system allowed him to transform AI outputs into polished, professional content in under 30 minutes per piece. I'm not fighting against AI, I'm working with it, he says. The technology handles the heavy lifting of initial research and drafting. I provide the quality control, expertise, and human elements that make content genuinely valuable. A typical workflow for Michael starts with generating a comprehensive first draft using AI tools. He then applies his own knowledge to correct any factual errors, adds relevant examples from his teaching experience, and rewrites key sections to match the client's brand voice. The final step involves injecting personality and ensuring the content flows naturally when read aloud. This approach allows Michael to deliver content that's both technically accurate and genuinely engaging, something businesses have found increasingly difficult to achieve with AI alone. The financial impact has been transformative. Within 3 months of launching his specialized service, Michael was consistently earning an extra $2,000 monthly while working just 10 hours weekly outside his teaching job. That breaks down to an impressive $50 per hour, significantly more than what general freelancing had offered. I'm not working more hours than before, Michael emphasizes. I'm just being smarter about how I leverage technology to multiply my productivity. The timing of Michael's discovery couldn't have been better. According to recent market research, the demand for human-edited AI content is surging. Companies are reporting that using these hybrid approaches has reduced content production time by up to 50% while maintaining quality standards that pure AI can't achieve. What makes Michael's story particularly interesting is how it contrasts with our previous examples. While Jennifer and Marcus built wealth through cryptocurrency investments, Michael found opportunity in the technology itself rather than the financial products it enables. Not everyone wants to put their savings into new financial instruments, Michael points out. For me, the immediate opportunity was in using AI to enhance skills I already had, not in speculating on digital assets. His success also highlights an often overlooked aspect of technological disruption. Sometimes the biggest opportunities aren't in the technology itself, but in the human expertise that complements it. The beauty of Michael's approach is its accessibility. Starting requires minimal upfront investment. Just subscriptions to AI tools like ChatGPT Plus or Claude, approximately $20 to $30 monthly, and the willingness to learn how to effectively prompt and edit AI outputs. For those interested in replicating Michael's success, he recommends starting with content niches where you already have expertise. The AI can help with structure and research, but your unique knowledge is what clients are really paying for, he advises. Michael has expanded his service offerings beyond just content editing. He now offers consulting services to small businesses looking to implement AI in their content strategies, commanding premium rates for his practical experience. I'm not a tech expert, he admits. I'm just someone who figured out how to make AI tools work effectively for specific business needs. That practical knowledge turns out to be incredibly valuable. What's particularly interesting is that businesses in specialized fields like finance, healthcare, and technology are willing to pay significantly more for human-edited content. According to Michael, financial firms often pay 3 to 4 times the rate of general content for articles that demonstrate genuine understanding of market trends and regulatory environments. By focusing on these premium niches, Michael has built a side business that generates consistent income without requiring him to quit his day job. He still teaches full-time, but Sophia's 6-figure success, from retail worker to crypto entrepreneur. Financial flexibility doesn't always come from owning crypto or editing AI content. Sometimes the biggest opportunity is hiding in plain sight, not in the technology itself, but in what crypto founders desperately need yet can't create with their coding skills alone. This exact blind spot helped one retail worker build a six-figure business without writing a single line of code. Meet Sophia, who just 2 years ago was folding clothes at a retail store and struggling to make ends meet. When she lost her job due to store cutbacks, Sophia found herself at a crossroads. Unlike our previous success stories, she didn't have specialized skills like Michael's teaching background or substantial savings like Jennifer. I had about $2,000 in savings and absolutely zero technical background, Sophia recalls. Everyone was talking about launching tokens or becoming developers, but I couldn't code to save my life. What she did have was an eye for people and communication, skills that don't show up on a resume, but make all the difference in building communities. While scrolling through Twitter, now X, and Discord channels, Sophia noticed something fascinating. Brilliant blockchain projects with amazing technology were failing because nobody was talking about them. These crypto founders could build incredible platforms, but they couldn't explain them to save their lives, she laughs. The disconnect was huge. All these technical geniuses with zero marketing skills were launching projects that nobody understood. Instead of viewing her lack of technical skills as a disadvantage, Sophia recognized a massive opportunity. While everyone else was trying to launch the next big token, she decided to focus on what she did best, connecting with people. Sophia started small, offering community management services to a local crypto meetup organizer who needed help growing their Discord server. For that first client, she charged just $500 a month, barely enough to cover rent, but it gave her a foothold in the industry and a chance to learn. What made Sophia's approach different was her clever use of AI tools from the very beginning. She discovered that platforms like Hootsuite and Buffer could help her analyze social media engagement patterns across successful crypto communities. She studied what worked, what didn't, and began building systems that could be replicated. I realized I didn't need to be a crypto expert. I just needed to understand what made communities tick, she explains. The patterns were surprisingly consistent across different projects. Within 3 months, Sophia had signed 3 clients paying monthly retainers. Her approach was simple but effective. Help legitimate blockchain projects build engaged communities that understood their value. She focused on translating complex technical jargon into language that average users could understand and get excited about. As her client list grew, Sophia faced a new challenge. She couldn't handle everything herself anymore. This is where her business model really took off. Instead of trying to do everything alone, she built a team of remote workers with complementary skills and used AI tools to multiply their productivity. I found amazing people from all over the world who had different strengths. Some were great at graphics, others at writing, and others at community engagement, she says. Then I created AI-powered workflows that let us handle multiple clients efficiently. Her team now uses AI tools to generate first drafts of content, analyze community sentiment, and optimize posting schedules. But Sophia is quick to emphasize that the human touch remains essential. The AI gives us a starting point, but my team adds the creativity, emotional intelligence, and cultural awareness that makes communities actually work. This hybrid approach, AI efficiency combined with human creativity, proved to be extremely valuable to crypto projects. Within a year, Sophia's client list had grown to include projects across 3 continents, with monthly retainers ranging from $3,000 to $8,000 depending on the scope of services. What makes her approach particularly brilliant is the pricing model. Sophia doesn't charge by the hour or deliverable. She offers retainer packages that provide consistent monthly income while giving clients the predictability they need for their budgets. Some clients also opt for performance-based incentives, where her agency earns bonuses for achieving specific community growth metrics. The numbers speak for themselves. Today, Sophia's agency generates over $240,000 in annual revenue with profit margins hovering around 40%. That's nearly $100,000 in profit from a business started with just $2,000 in savings and no technical background. The irony is that so many people were chasing crypto gains through trading or investing, while I built a more stable business just helping projects connect with their audiences, she reflects. I never had to worry about token prices crashing because my income wasn't tied to any particular cryptocurrency. What's particularly impressive about Sophia's story is how she positioned herself at the intersection of two explosive trends, AI and cryptocurrency. While she doesn't develop either technology, she leverages both to create value for her clients. Her agency now specializes in several key services that most crypto projects desperately need. Community management on Discord and Telegram, where crypto projects engage directly with their users' content creation that explains complex blockchain features in accessible language, social media management across Twitter, Instagram, and emerging platforms' growth strategy for expanding user bases beyond the typical crypto enthusiast crisis management when projects face technical issues or community concerns. What surprised me most was discovering that many crypto founders actively dislike the marketing and community aspects of their projects, Sophia explains. They're brilliant at building the technology, but uncomfortable with the human side of business. That's the gap I fill. This insight has proven incredibly valuable. While countless people are trying to predict which cryptocurrencies will moon next, Sophia has built a stable business that thrives regardless of market conditions. In fact, her services become even more valuable during bear markets when projects have to work harder to maintain community interest. The best part, Sophia's business model scales. Unlike Michael, who trades his time for money, albeit at a premium rate, Sophia has built systems that allow her team to serve more clients without requiring proportionally more time. I spent the first 6 months working 12-hour days to build the foundation, she admits. But now I have processes and people in place that let me focus on strategy and growth rather than daily implementation. This scalability has allowed Sophia to expand her service offerings beyond just community management. Her agency now helps crypto projects with complete marketing strategies, including content planning, influencer collaborations, and even fundraising support. The key to her success has been focusing on legitimate projects with actual utility rather than speculative tokens. I only work with projects that I believe add real value, she says. That means saying no to a lot of potential clients, but it's kept my reputation solid in an industry where trust is everything. Sophia's story highlights an often overlooked path to success in emerging tech fields, providing critical supporting services rather than trying to compete in oversaturated areas. While millions dream of launching the next Bitcoin or creating an AI breakthrough, there's often more reliable money to be made in helping those innovators succeed. For anyone inspired by Sophia's journey, she offers this advice. Look for the pain points in growing industries. What do the technical founders struggle with? What do they dislike doing? That's your opportunity. The lesson is clear. You don't need coding skills or deep technical knowledge to build wealth in the crypto space. Sometimes the most profitable position is providing what others can't or won't do themselves. David's retirement protection, AI-powered portfolio management. Think cryptocurrency is just for young tech enthusiasts with decades to recover from losses? At 58, David faced a retirement crisis that traditional financial wisdom couldn't solve, until he discovered how AI could help him safely tap into digital assets without putting his life savings on the line. David had spent decades building his nest egg, accumulating $420,000 for retirement. But as he approached his golden years, he watched with growing anxiety as inflation steadily eroded his purchasing power. His traditional investment portfolio was barely keeping pace with rising costs, and the financial future he'd planned for was looking increasingly uncertain. Every month, I'd check my statements and feel this knot in my stomach, David recalls. The money I'd worked so hard to save was effectively shrinking, while my financial advisor kept collecting the same fees regardless of performance. Those fees were another source of frustration, typically between 1 to 2% of assets under management annually. While that might not sound like much, it amounted to thousands of dollars each year from David's retirement funds, regardless of whether his investments performed well or poorly. The breaking point came when David calculated that his advisor's mediocre returns, after fees and adjusted for inflation, meant he was essentially treading water financially. I realized I needed a different approach if I wanted to actually enjoy retirement instead of constantly worrying about money, he says. Unlike our previous case studies, David couldn't afford to take significant risks. At his age, there simply wasn't enough time to recover from major investment mistakes. But he also couldn't afford to do nothing while inflation continued eating away at his savings. His journey to a solution began unexpectedly during a conversation with his nephew, who worked in financial technology. He mentioned these new AI portfolio management tools that could analyze thousands of investment options simultaneously, identifying opportunities that human advisors might miss, David explains. Initially skeptical, David began researching AI-powered investment platforms. What caught his attention was their ability to provide personalized recommendations based on specific risk tolerances and time horizons. Exactly what someone in his position needed. After careful consideration, David decided to try Tokenized, an AI-powered analysis platform that examines both traditional and cryptocurrency markets. Unlike many robo-advisors that focus solely on stocks and bonds, Tokenized offered insights into the emerging digital asset class while still prioritizing risk management. The difference was immediately apparent, David says. Instead of generic advice about asset allocation, I was getting specific recommendations tailored to my situation as someone nearing retirement who needed stability, but also some growth potential. The AI analysis suggested a conservative approach to cryptocurrency, allocating just 12% of his portfolio to digital assets. This aligned perfectly with research showing that for conservative investors nearing retirement, a recommended cryptocurrency allocation typically falls between 10 to 15% of their overall portfolio. David's cryptocurrency allocation was carefully structured. 5% in Bitcoin as a digital store of value, 4% in Ethereum as exposure to the growing smart contract ecosystem, and 3% in regulated stablecoins earning interest through vetted platforms. The remaining 88% stayed in traditional investments, though even these were optimized through AI analysis. What impressed me most was how the AI tools could explain their reasoning in plain English, David notes. I didn't need to understand complex algorithms. I just needed to know why certain assets made sense for my situation. To further reduce risk, David implemented two strategies recommended by the AI platform. First, he set up automatic alerts that would notify him of significant market shifts requiring attention. Second, he used dollar-cost averaging, investing a fixed amount at regular intervals rather than all at once, to reduce the impact of market timing and volatility. The system sends me an alert if Bitcoin drops below a certain threshold or if there's unusual activity in any of my holdings, David explains. It's like having a financial advisor who never sleeps, but without the hefty fees. Speaking of fees, the difference was substantial. While David's previous financial advisor charged around 1.5% annually, approximately $6,300 on his $420,000 portfolio, the AI-powered tools cost just $50 monthly, or $600 annually. This 90% reduction in fees meant more of David's money stayed invested and working for him. The results exceeded David's expectations. After 16 months, his AI-managed portfolio had outperformed his previous advisor's returns by 8.2% annually after accounting for all fees. This impressive performance came not from taking bigger risks, but from more efficient allocation and reduced costs. I'm not getting rich quick, and that was never the goal, David emphasizes. What I wanted was to protect what I've worked for and maybe grow it enough to actually enjoy retirement without constant financial stress. An unexpected benefit came from the stablecoin portion of David's cryptocurrency allocation. These digital assets, pegged to the US dollar, were generating 4 to 5% annual yields through regulated lending platforms, significantly more than traditional savings accounts or CDs without substantially increasing risk. It's not a huge portion of my portfolio, but it's nice to see those interest payments coming in regularly, David says. In today's economy, finding safe ways to earn yield matters, especially for retirees. David also appreciates how the AI tools adapt to changing market conditions. When regulatory news affects the cryptocurrency sector, the system suggests appropriate adjustments. During traditional market volatility, it recommends rebalancing opportunities. The flexibility is valuable, David notes. Traditional financial advisors often stick to the same playbook regardless of what's happening in the world. The AI approach seems more responsive. For those in similar situations, approaching retirement with concerns about inflation, David suggests starting small and focusing on education. I spent 2 months just learning before I moved any money, he recalls. Understanding the basics of blockchain technology and how cryptocurrencies function gave me the confidence to make informed decisions. David's journey demonstrates that even conservative, Investors nearing retirement can benefit from carefully allocated exposure to digital assets, especially when guided by sophisticated AI risk management tools. The key is finding the right balance, enough exposure to benefit from the growth potential without jeopardizing retirement security. His approach also highlights the growing accessibility of sophisticated financial tools. Just a few years ago, the kind of portfolio analysis David now uses would have been available only to ultra-wealthy investors. Today, these AI-powered insights are available to anyone with a smartphone and a modest subscription fee. There's still this perception that cryptocurrency is just for young people or tech enthusiasts, David observes. But when approached correctly, with proper risk management and realistic expectations, it can be a valuable component of a retirement strategy. Perhaps most importantly, David's experience demonstrates how technology can empower individuals to take control of their financial futures without needing to become experts in every investment category. The AI tools handle the complex analysis while providing clear, actionable recommendations that ordinary people can understand and implement. The three biggest mistakes beginners make with AI and crypto. While AI tools helped David navigate his retirement strategy successfully, most people aren't so fortunate. The painful truth? A shocking 67% of newcomers to the AI and crypto space watch their money disappear because they fall into three predictable traps that even financially savvy individuals miss until it's too late. Throughout our journey with Marcus, Jennifer, Michael, Sophia, and David, we've seen how technology can transform financial futures when used correctly. But what separates their success stories from the majority who fail? Let's dissect the three wealth-killing mistakes you need to recognize before putting your first dollar at risk. Mistake number 1. Diving into high-risk investments without understanding blockchain fundamentals. Remember how our successful case studies all began their journeys? None of them jumped straight into volatile crypto assets. Instead, they invested time and education first. This stands in stark contrast to what most beginners do. One of the most prevalent mistakes is jumping into high-risk investments without understanding the fundamentals of blockchain technology. Many beginners lack the necessary education to differentiate between speculative investments and those with genuine utility. This education gap creates a dangerous situation. Without understanding what gives different cryptocurrencies their actual value, beginners essentially gamble rather than invest. They chase tokens trending on social media or hyped by influencers without evaluating the underlying technology or use case. Think of it like buying stock in a company without knowing what product they sell or how they make money. Would you invest your hard-earned cash in a business you knew nothing about? Yet, that's exactly what happens every day in the crypto space. The solution isn't complicated, but it requires something most beginners aren't willing to give: time. Taking just 2 to 3 weeks to understand blockchain basics, smart contracts, and the difference between various types of digital assets can dramatically improve your decision-making. Free resources like Coinbase Learn, reputable YouTube channels, and community forums provide accessible entry points to build this foundational knowledge. What separates tokens with staying power from those that vanish overnight? It comes down to utility. What real-world problem does the project solve? Who's on the development team? What's their track record? Is there transparent governance? These questions become second nature once you've built a basic understanding of the technology. Mistake number 2, putting all your eggs in one crypto basket. The second wealth-destroying mistake is a familiar one in traditional investing that becomes even more dangerous in the crypto world: lack of diversification. Another critical error is putting all their money into a single platform, token, or strategy instead of diversifying across regulated options. This lack of diversification can lead to significant losses, as evidenced by the experiences of many new investors. I've seen countless stories of people who went all in on a single exchange or platform, only to lose everything when that platform faced security issues or bankruptcy. Remember FTX? Celsius? These collapses wiped out life savings because users concentrated their assets in one place. Look at how our case studies approached diversification. Jennifer spread her stablecoin investments across multiple lending platforms. David maintained a careful balance of traditional investments with a strategic allocation to different digital assets. Marcus followed a strict rule of never keeping more than 15% of his holdings on any single platform. Smart diversification in the crypto space. means spreading your investments across different blockchains, not just Ethereum or Bitcoin, multiple regulated exchanges and platforms, various asset types, stablecoins, blue-chip cryptos, tokenized real-world assets, different strategies, lending, staking, liquidity provision. This approach creates resilience. If one platform faces issues or a particular token underperforms, your entire portfolio isn't at risk. Yes, it requires more management, but the security trade-off is well worth it. For beginners, establishing accounts on 2 to 3 regulated exchanges provides immediate diversification benefits. As your knowledge grows, you can further diversify across different types of assets and strategies based on your risk tolerance. Mistake number 3. Overlooking tax implications until it's too late. The third mistake might not be as immediately devastating as the first two, but it can silently erode your gains over time, ignoring tax responsibilities. Ignoring tax implications is a common pitfall for crypto investors. In many jurisdictions, profits from cryptocurrency trading are subject to capital gains tax, and rewards from staking or yield farming may be classified as ordinary income, which can lead to unexpected tax burdens. Many crypto enthusiasts get a rude awakening when tax season arrives. They've made profitable trades throughout the year, but haven't set aside funds to cover their tax obligations. Even worse, they often lack the necessary documentation to properly report their activities. Investors often fail to keep detailed records of their transactions, which is crucial for accurate tax reporting. This oversight can complicate their financial situation when tax season arrives. Each of our case studies incorporated tax planning into their strategies from day one. They understood that crypto transactions create taxable events in most countries. Selling crypto for profit, exchanging one cryptocurrency for another, or earning rewards through staking or lending, all potentially trigger tax obligations. The most successful crypto investors maintain meticulous records of purchase dates and prices, sale dates and prices, fees paid on transactions, rewards earned through staking or lending, platform-specific tax documents. Several specialized crypto tax software solutions can help track these details and generate necessary tax forms. Many of these tools integrate directly with major exchanges to automatically import your transaction history. Beyond record-keeping, strategic tax planning can significantly impact your returns. For example, holding assets for longer than a year may qualify you for lower long-term capital gains rates in many jurisdictions. Using tax-advantaged accounts for certain crypto investments or timing your gains and losses strategically can also optimize your tax situation. Missing these opportunities doesn't just mean paying more taxes. It can mean unexpected tax bills that force you to liquidate investments at inopportune times, disrupting your long-term strategy. The difference between success and failure. What's fascinating about these 3 mistakes is that they're not technical barriers. You don't need a computer science degree or financial expertise to avoid them. Instead, they're behavioral patterns that anyone can address with awareness and discipline. When I look at the journeys of Marcus, Jennifer, David, Sophia, and Michael, I see a consistent emphasis on education before action. They approached the crypto and AI space with humility, acknowledging what they didn't know and taking time to learn. They built diversified positions gradually rather than making large, concentrated bets. And they treated their crypto activities as serious financial matters, with proper record-keeping and tax planning from the start. Educational resources for beginners include platforms that offer insights into blockchain fundamentals, such as online courses and community forums. Engaging with these resources can significantly improve an investor's understanding and decision-making capabilities. Notice that none of our case studies chased get-rich-quick schemes or tried to time the market perfectly. Instead, they focused on building sustainable strategies based on income generation rather than price speculation. They prioritized regulated platforms with clear security measures. And they maintained realistic expectations about returns, understanding that consistent moderate gains compound over time. For most people, the path to success in this space isn't about finding the next 100x token. It's about leveraging these emerging technologies to earn steady returns while managing risk appropriately. Your first steps, starting with AI and crypto at any income level. Those steady returns aren't just for people with deep pockets. The truth is, you can start building wealth with AI and crypto, whether you've got $100 or $100,000 in your bank account. The perfect entry point has nothing to do with your current balance, and everything to do with understanding which approach fits your specific situation. I receive hundreds of messages each week asking, how do I actually get started? Today, I'm breaking down the exact first steps based on your current financial situation. No more wondering if you're doing it right, or if you need more money to begin. Let's be honest, most people get completely stuck at the starting line. They're paralyzed by too many options, conflicting advice, and the fear of making expensive mistakes. You might be thinking you need thousands of dollars or technical expertise just to get your foot in the door. That's simply not true. The key to success isn't about jumping into the deepest end of the pool immediately. It's about matching your entry strategy to your current resources, risk tolerance, and financial goals. Let me show you exactly how to do that. If you're starting with under $1,000, you're in a similar position to where Marcus began his journey. Your focus should be primarily on education first, then making small initial investments on regulated exchanges. Platforms like Coinbase offer a user-friendly interface and allow you to start investing with as little as $100. What makes Coinbase particularly suitable for beginners is their regulated status and FDIC insurance for USD balances up to $250,000, providing important security as you learn the ropes. But don't skip the education phase. Even with small amounts, you should spend 2 to 3 weeks understanding blockchain fundamentals before making your first investment. Free resources like Coinbase Learn can give you that foundation without costing a penny. Once you've built that knowledge base, start with small positions in established cryptocurrencies or stablecoins that offer modest yields. For those with $1,000 to $10,000 to allocate, Jennifer's approach offers a compelling blueprint. This is where you can begin implementing a more diversified strategy across multiple platforms. With this amount of capital, you can spread your investments across several regulated stablecoin platforms to generate passive income while minimizing your exposure to any single platform. The beauty of Jennifer's strategy is that it focuses on income generation rather than speculation. You're not betting on price appreciation, you're earning steady yields. Platforms like InvestEngine allow you to start with as little as $1 and offer a range of ETFs while being regulated by the Financial Conduct Authority. This provides both accessibility and security as you build your portfolio. At this funding level, you can also begin exploring more sophisticated DeFi opportunities that offer higher yields, while still keeping the majority of your capital in more secure, regulated environments. The key is to gradually increase your positions as you gain confidence and understanding of how these platforms work. For those with $10,000 to $100,000 to invest, David's balanced portfolio approach becomes viable. With this level of capital, you can implement a more comprehensive strategy that includes traditional investments alongside carefully selected crypto assets. Much like David, you might consider allocating 10 to 15% of your portfolio to digital assets while using AI-powered tools to help manage risk and identify opportunities. At this level, you can afford subscriptions to premium AI analysis tools that provide detailed insights into market trends and potential investments. These tools can help you make more informed decisions about asset allocation and timing, similar to how David outperformed his previous financial advisor's returns. You might also consider dollar cost averaging into your positions rather than investing all at once. This approach helps mitigate the impact of market volatility and reduces the stress of trying to time the market perfectly. Setting up automatic purchases on a weekly or monthly basis can be an effective way to build your positions gradually while minimizing risk. But what if you don't have much money to invest at all? That's where Michael's approach comes in. If you're looking to build skills rather than deploy capital, consider using AI tools to enhance marketable services. This strategy requires minimal upfront investment, just subscriptions to tools like ChatGPT Plus or Claude, which cost around $20 to $30 monthly. The advantage of this approach is that you can start generating income immediately without risking significant capital. You're essentially investing in your skills and using AI as a force multiplier for your productivity. As your income grows, you can then allocate a portion to more traditional investment strategies. For those concerned about security and ease of use, mobile apps like Plum enable investing in over 1,800 stocks and offer automated savings based on user-defined goals. Designed with simplicity in mind, These platforms are perfect for beginners who want to start with minimal amounts while gaining confidence in the investment process. Regardless of your starting point, the safest entry for most people is through regulated stablecoin platforms with FDIC-insured partners. These platforms combine the benefits of blockchain technology with some of the protections of traditional finance, creating a bridge for newcomers to enter the space more confidently. What's remarkable is that you can begin with as little as $100 on many of these platforms. That's not a typo. Just $100 can get you started on the path to generating passive income through cryptocurrency. Of course, the returns on $100 won't change your life overnight, but they allow you to learn the process and gain confidence before committing larger sums. It's also crucial to understand the risks involved with crypto investments. The market can be highly volatile. There's always the potential for hacking incidents, and these investments lack many of the regulatory protections found in traditional financial systems. Being aware of these risks is essential for making informed decisions about how much to invest and where. Remember, every successful investor in our case studies started somewhere. Marcus began with just $300 after losing his first $200. Jennifer started with $5,000 spread across multiple platforms. David allocated just 12% of his retirement savings to cryptocurrencies. The common thread wasn't their starting capital. It was their commitment to education, risk management, and gradual expansion. So what's the right approach for you? If you're completely new to both AI and crypto, I recommend starting with education regardless of your available capital. Spend at least 2 to 3 weeks learning the fundamentals before making any investments. During this time, you can set up accounts on regulated exchanges and familiarize yourself with their interfaces without risking any money. Once you've built that foundation, start small. Even if you have $50,000 available, begin by investing just $500 to $1,000 to get comfortable with the process. Experience the emotions of seeing your investment fluctuate in value. Test the withdrawal process to ensure you understand how to access your funds if needed. As your confidence grows, gradually increase your exposure based on your risk tolerance and financial goals. Continue educating yourself about new developments in the space, but resist the temptation to chase every trending token or project. Focus on building a sustainable strategy aligned with your long-term objectives. The tools and platforms powering these success stories. Having the right strategy is just half the battle. The tools you use can make or break your success in the crypto world. You might be wondering what actually separates successful investors from those who struggle. The answer often lies not in some secret formula, but in the specific platforms and tools they use every single day. Let's peek inside the digital toolbox of our 5 successful crypto investors. These aren't just random recommendations. They're the battle-tested platforms that turned ordinary people into crypto success stories, and some won't cost you a penny to start using. When it comes to making smart investment decisions, both Marcus and David rely heavily on AI-powered analysis tools. Tokenmetrics stands out as their go-to platform for comprehensive crypto data and insights. What makes Tokenmetrics special is how it helps users cut through the noise of thousands of cryptocurrencies by providing detailed analysis on fundamentals, technical indicators, and market sentiment, all in one place. Magnify serves as another powerful ally in their investment arsenal. What's particularly impressive about Magnify is its personality engine that tailors investment strategies to your individual profile. Whether you're risk-averse like David or more growth-oriented like Marcus, Magnify adapts its recommendations to match your specific investment style. This personalization makes it accessible regardless of your experience level. You don't need to be a crypto expert to benefit from its insights. Magnify offers a unique personality engine that matches investment strategies to individual investor profiles, making it accessible for users with varying levels of experience, according to recent user reviews. This kind of personalized approach helps explain why our case studies have been able to navigate the complex crypto landscape with greater confidence. Security remains a top priority for all 5 of our investors. When it comes to protecting their digital assets, they've unanimously chosen hardware wallets, with Ledger being the preferred option. Think of a hardware wallet like a tiny, ultra-secure digital vault that keeps your crypto keys completely offline and away from potential hackers. Hardware wallets like Ledger provide secure storage for cryptocurrencies, protecting users from hacks and unauthorized access, which is crucial for safeguarding digital assets, notes a recent security analysis. These physical devices typically cost between $60 to $150, but that's a small price to pay for peace of mind when you're storing thousands of dollars worth of digital assets. User sentiment strongly supports this security-first approach. User reviews indicate that Ledger hardware wallets are highly rated for their security features, making them a preferred choice among crypto investors. While software wallets offer convenience, hardware solutions provide that extra layer of protection that serious investors simply can't do without. For passive income generation, particularly important to Jennifer's strategy, several DeFi platforms have proven their worth. Aave and Compound stand out as her primary vehicles for generating steady returns through stablecoin lending. These platforms allow users to lend their cryptocurrency assets to others and earn interest in return. Similar to how a bank might pay you interest, but typically at much higher rates. DeFi platforms like Aave and Compound have been rated positively for their reliability and user experience, making them suitable for generating passive income, according to industry assessments. These platforms operate with smart contracts that automate the lending process, allowing Jennifer to earn consistent returns without constant maintenance. For regulated options with lower risk profiles, Coinbase USDC lending program provides a more beginner-friendly entry point. While the yields might be slightly lower than pure DeFi alternatives, the added security and regulatory oversight make it an excellent starting point for those new to crypto lending. On the AI productivity side, Michael and Sophia have built their income streams using a combination of powerful tools. Both rely heavily on Claude and ChatGPT+ for content creation and analysis, but they've also incorporated specialized AI tools for specific needs. Michael uses AI writing assistants to create first drafts that he then enhances with his expertise, while Sophia leverages AI analytics to identify engagement patterns across various crypto communities. For those just starting out, the most approachable entry point might surprise you. It's actually educational platforms. Coinbase Learn and Earn program allows users to earn free cryptocurrency while learning about different digital assets, making it a beginner-friendly educational platform. This innovative approach literally pays you to learn the fundamentals, allowing you to build both knowledge and a small crypto portfolio simultaneously. Educational platforms like Tokenized provide comprehensive crypto data and insights, helping users make informed investment decisions. Before risking your hard-earned money, spending time on these educational resources can significantly improve your chances of success. What's remarkable about these tools is how they complement each other. Marcus combines Tokenized for analysis with Ledger for security and Aave for passive income. Jennifer spreads her investments across multiple DeFi platforms while using hardware wallets to secure her private keys. David leverages AI analysis to manage his portfolio while maintaining tight security protocols. The common thread is using the right tool for each specific need rather than trying to find a single platform that does everything. The financial barrier to entry is lower than you might expect. Many of these platforms offer free tiers or low-cost entry points. Coinbase allows you to start with as little as $10. Magnify provides basic analysis features in its free tier. Even premium services like Tokenized offer affordable monthly subscriptions that quickly pay for themselves through better investment decisions. When building your own crypto toolkit, start with security and education before moving to investment platforms. A secure foundation protects your assets while proper education helps you avoid costly mistakes. Only after establishing these fundamentals should you begin exploring investment opportunities. For beginners, establishing a simple toolkit might look like this. Start with Coinbase Learn and Earn program to build basic knowledge and earn your first crypto. Set up a Ledger hardware wallet once your portfolio exceeds $1,000. Use Magnify's free tier to understand investment strategies that match your risk profile. As your knowledge and portfolio grow, gradually incorporate more specialized tools like DeFi platforms for passive income generation. Remember that fancy tools don't guarantee success. They merely amplify good decision-making. All 5 of our case studies spent significant time learning before heavily investing. The tools accelerated their progress but couldn't replace the foundational knowledge they built first. The beauty of today's crypto ecosystem is its accessibility. Just a few years ago, these sophisticated investment and analysis tools were only available to institutional investors with deep pockets. Today, anyone with a smartphone and internet connection can access professional-grade crypto infrastructure. The democratization of financial tools means ordinary people can implement strategies previously reserved for the financial elite. When selecting platforms, prioritize those with strong security track records, transparent fee structures, and positive user reviews. Avoid platforms promising unrealistic returns or those with limited security information available. The crypto space still contains predatory services looking to separate beginners from their money through hidden fees or outright scams. As your journey progresses, you'll likely find yourself using different tools for different purposes. You might use Coinbase for simple buying and selling, DeFi platforms for passive income, hardware wallets for long-term storage, and AI analytics for market research. This multi-platform approach provides both optimization and risk diversification. Starting your crypto journey with the right tools dramatically improves your chances of success. The platforms our case studies use aren't magical. They're simply well-designed tools that solve specific problems in the crypto investment process. By adopting similar tools and applying the same thoughtful approach to their use, you can implement comparable strategies regardless of your starting point. The future of AI and crypto wealth building, emerging opportunities. While the tools our investors use are impressive, they're already looking beyond the horizon at something potentially revolutionary. What happens when AI doesn't just analyze markets, but actively governs entire investment systems? Our 5 success stories are positioning themselves at the intersection of technologies that could transform everything we know about wealth creation. The world of tokenized real-world assets is exploding with potential. Experts project this market will reach an astounding $16.3 billion by 2028, growing at a breathtaking rate of 38.5% annually. This isn't just another crypto trend. It's a fundamental reimagining of how we own and trade valuable assets. Marcus has shifted his focus from simple tokenized real estate to AI-governed DAOs that automatically distribute profits to token holders. These aren't your typical investment vehicles. Imagine owning a digital token that represents partial ownership in an apartment building, retail space, or office complex. The revolutionary part? AI systems handle tenant relationships, maintenance scheduling, and even rent collection, then automatically distribute your proportional earnings directly to your wallet. I'm particularly excited about DAOs that use artificial intelligence to handle governance and operations, Marcus explained during our interview. The technology streamlines profit distribution while enhancing operational efficiency in ways traditional real estate investing never could. Jennifer, with her trademark cautious approach, hasn't abandoned her stablecoin strategy that replaced her salary. However, she's now exploring tokenized carbon credits and sustainability projects. These emerging assets offer something uniquely appealing: financial returns alongside positive environmental impact. My risk tolerance hasn't changed, Jennifer told us. But what I love about these sustainability tokens is they align with global environmental goals while still delivering competitive yields. She's carefully researching projects that verify and tokenize carbon offsets, allowing businesses to purchase these credits to meet their sustainability targets. The beauty of blockchain here is transparency. The impact of each credit can be traced and verified, eliminating the greenwashing that plagues traditional environmental markets. Michael's approach to the future is particularly interesting. Rather than diving deeper into the content creation side, he's leveraging his AI expertise to develop systems that help small businesses accept and manage cryptocurrency payments. Many local shops want to accept digital currencies, but lack the technical knowledge to implement and manage these systems. Most small business owners I know are intrigued by crypto, but intimidated by the complexity, Michael shared. I'm building simplified interfaces that handle the back-end complexities while giving them an easy dashboard to track everything. His solution automatically converts a portion of crypto payments to traditional currency for business expenses while keeping some in digital assets as a growth strategy, all managed by AI algorithms that optimize for tax efficiency. Sophia's community management agency is evolving too. She's watching the development of AI-managed smart contracts with particular interest. These self-executing agreements could revolutionize how our clients distribute rewards to community members and automate financial transactions based on specific actions or milestones. The future isn't just about better analysis. It's about automating entire business processes, Sophia explained. Smart contracts powered by AI can handle complex decision-making that previously required human intervention. She envisions a system where content creators in her communities automatically receive compensation when certain engagement metrics are reached, all verified and executed by blockchain technology. David, our near-retirement investor, is taking a typically measured approach to these new opportunities. He's particularly interested in how AI-managed smart contracts can execute complex financial strategies while minimizing risk. For someone in his position, the appeal is clear: automated income generation with reduced volatility. At my stage of life, I need reliability more than explosive growth, David noted. The combination of AI risk management with blockchain's transparency offers something traditional retirement vehicles simply can't match. What connects all these emerging strategies is the move toward tokenization of real-world assets. Beyond real estate, we're seeing fine art, infrastructure projects, intellectual property, and even revenue streams being tokenized and traded on blockchain platforms. This creates unprecedented liquidity in traditionally illiquid markets. Think about it. Historically, investing in commercial real estate required hundreds of thousands in capital, extensive legal documentation, and significantly restricted liquidity. Now, tokenization allows investors to purchase fractional ownership with minimal capital, trade their positions easily, and receive automated income distributions, all secured by immutable blockchain records. The impact extends beyond traditional investments. Intellectual property rights, like music royalties, patent licensing fees, and creative works, are increasingly being tokenized. This allows creators to raise capital by selling partial rights while maintaining creative control, and enables investors to access income streams previously reserved for industry insiders. What makes these opportunities particularly compelling is how they combine blockchain's security and transparency with AI's analytical capabilities. Artificial intelligence can continuously monitor asset performance, adjust strategies based on market conditions, and optimize returns while operating within predefined risk parameters. However, there are important caveats to consider. These emerging asset classes exist in a regulatory environment that's still developing. While major jurisdictions are creating frameworks for digital assets, the rules around tokenized real-world assets remain in flux. Our investors unanimously emphasize the importance of sticking with platforms and projects that proactively work with regulators. Additionally, the technology itself continues to evolve rapidly. Smart contracts that manage complex financial arrangements may contain bugs or vulnerabilities that could compromise funds. This is why our case studies consistently emphasize starting small and diversifying across multiple platforms and asset types. The timing of these opportunities is particularly notable. As traditional financial markets face increasing volatility and economic uncertainty, tokenized real-world assets offer an interesting alternative. They provide income streams partially insulated from stock market fluctuations while offering liquidity that traditional alternative investments lack. For average investors, the entry points are becoming increasingly accessible. Several regulated platforms now offer tokenized real estate opportunities starting at just $100, allowing even those with limited capital to build diversified portfolios of income-generating assets. What excites me most is how these technologies are democratizing access to investment classes that were previously available only to the wealthy, Marcus explained. I never thought someone with my background and limited starting capital could access institutional-grade real estate investments. The sustainability aspect shouldn't be overlooked either. Jennifer's interest in tokenized carbon credits highlights an important trend. Increasingly, investors want their money to generate both financial returns and positive real-world impact. Blockchain technology enables unprecedented transparency in tracking environmental and social outcomes, allowing investors to verify the impact of their capital. I can literally see the renewable energy projects my money is funding and track their carbon offset in real time, Jennifer noted. That kind of transparency just doesn't exist in traditional ESG investments. For those interested in exploring these opportunities, our investors suggest starting with education rather than immediate investment. Several platforms now offer detailed resources explaining tokenized assets and their underlying technologies. Many provide simulation tools that allow you to practice without risking real capital. When you're ready to begin, consider allocating a small percentage of your investment portfolio to these emerging asset classes. The common approach among our case studies is to start with 5 to 10% of their investable assets, focusing on regulated platforms with transparent fee structures and clear regulatory compliance. What's particularly exciting is how these technologies complement rather than replace traditional financial strategies. David's approach exemplifies this. He maintains a core portfolio of traditional investments while strategically incorporating tokenized assets to enhance returns and provide additional income streams. The key lesson from all 5 investors is clear. The most sustainable wealth-building strategies combine proven financial principles with emerging technology. This means maintaining proper diversification, focusing on assets that generate actual value, understanding your risk tolerance, and avoiding the hype cycles that often accompany new technology. As we wrap up, there's a powerful trend we can't ignore. The widespread adoption of AI and crypto technologies is accelerating faster than ever. In 2024 alone, 65% of organizations report regular use of generative AI, nearly double from just a year ago. This isn't just for tech giants anymore. What makes our 5 success stories work isn't coding expertise or massive capital. It's education first, action second, and risk management always. The research confirms this approach is crucial as AI has made crypto scams more sophisticated, highlighting why informed investing matters more than ever. The good news: by 2025, these technologies will become even more accessible through user-friendly platforms designed for non-technical users. You don't need to understand every technical detail. Just start small, learn consistently, and build gradually. The democratization of these tools means average people, yes, that includes you, can now participate